Good afternoon, everybody. Uneducated Economist here. Thought I'd talk a little bit about these pension funds. I got an article I'm going to leave down in the description for you guys. It's a Wall Street Journal article. Now, these pension funds are underfunded. And this is something that we have talked about many times in the past. And it's not something that a lot of people put a lot of concern towards. I guess they feel that these pension funds can't default or something. But I don't feel that's the case. I mean, governments could come in and try to bail them out. But in that case, it still doesn't provide the cost of living that these pension funds are promising to pay. Now, here's the major issue. These pension funds have promised way more than what they have. So they are underfunded. If everybody came in to claim their retirement, the pension fund wouldn't be able to pay it. And now they have been in desperate need of an interest rate. They are searching out for interest rates to get a return. They're looking for that yield. And as interest rates have been dropping, the safe, secure investments like U.S. Treasuries are no longer like a viable investment for a lot of these pension funds, as the return on the investment is just too small for them to, use it in their portfolios. They need a much bigger return. So a lot of these pension funds have moved into high-yielding corporate debt. And now it's not exactly like junk bonds that they are moving into, because I believe a lot of these pension funds are limited on what it is that they can purchase and put into those funds. And a lot of them have to be a particular credit rating. And most junk bonds don't meet the credit rating that these pension funds are needing in order to put it in their portfolio. But what they can do is they can bunch up loans from corporations who typically are so in debt or in such a bad credit rating that they can't even sell junk bonds. And so what they end up doing is they borrowing money from a bank, and then these banks put it into what's called the collateralized loan obligation. Now, CLOs are very much like when the housing market turned, we had a bunch of mortgage-backed securities that were jumbled up, that were toxic. Okay, very similar thing has taken place inside of these CLOs, where they take a bunch of these really bad loans, like loans to companies that are really in bad credit rating and very questionable on whether or not they're going to pay it back, and they jumble it up into a package. And then what they do, these people who bundle it up into a package, is they dice it all up, and then they put it into what they call tranches. And so when these companies go to pay their debt, when they go to pay their loan, all this money comes in. In the highest level tranche, they get paid first, and then it starts going into the next levels down. As you go down in these levels, the interest rates that they pay goes up, but it's really high risk. And so you have to think what's going into it into the beginning is a very high risk investment to begin with, because you're loaning money to a corporation that has a really bad credit rating. But because it's put into this package, and those packages are now in different levels, and the money that comes in, it doesn't matter. It doesn't matter where the individual loan is in that package. All the money comes in, it still pays the highest tranche first. So the investors who are bought into that particular level, they get paid first, guaranteed. So as long as enough of these corporations pay their debt, then those high level positions inside of those packages, those CLOs, that highest level tranche, they're going to pay. And they're given a higher credit rating. And these pension funds can buy those. Now think about that for a second. Pension funds who typically would not be able to loan money to a corporation because of their credit rating can now loan money to a corporation through these CLOs by buying that highest level tranche. Something to think about. Now, we're coming into a situation in which that I feel that there is going to be a liquidity issue. And now, if you go and look at Evergrande over in China, it's going to be something very similar to that. Now, granted, Evergrande's a corporation in a whole other foreign country and not the entire United States. But it's going to be something similar to that, in which that these corporations are going to come to a point where they're going to find themselves in a position in which they cannot make their payments to their debt holders. And that is going to force them to start selling off assets. I feel that that is going to take place inside of the pension funds in two ways. One, these corporations may end up finding a position, or may find themselves in a position in which they begin to default. And if those defaults get big enough, it could lead into the CLOs, and those CLOs turning into a toxic asset, since they're already filled with toxic assets when you think about it. So now, if that was to take place, then these corporate or these pension funds who have these investments will need to start selling these assets off. For one, they need to pay the pension, right? The pensioner, the person who's actually retiring, which is increasing by the day. Not only do they have to pay them, but they also have to make sure that they stay in a position in which that they stay liquid themselves, which means that if they have a depreciating asset like that, they're going to have to start selling, and selling fast. That is a very scary situation to be in. A lot of people are just not cluing in on this return on capital investment and how it's slowing things down. It's going to get bigger than that, because if it does get to a point where these pension funds begin to sell these assets, a lot of it is like the bonds from these corporations. Now you think about this, if it happens in the same fashion that Evergrande went down, where they start selling these bonds, like the bond holders are like, man, we need to get out of this debt fast because they're not going to pay it, then all of a sudden you have where these bonds are not selling for the price that they once had, and these corporations cannot make their debt payment, because it's all a matter of rolling old debt into new debt. So if you're rolling your old debt into new debt, and all of a sudden the new debt has become very expensive, and you cannot borrow the money to pay the old debt, then you're starting to sell your assets off to do it. And that is where the selling starts to happen, as they are trying to get out of those positions in order to pay off their bondholders, in order to keep from defaulting. And this selling can start spreading. Now think about it over here in the United States. If something like that was to happen with these pension funds, and they start selling off these corporate debt, and the corporations out there all of a sudden find themselves in a position in which that the interest rates are rising faster than they can handle, and they can't roll their old debt into new debt, how are they going to come up with the money to start paying their bondholders? They're going to start selling stock. And now you think about all the stories that you've heard over the last few years about all the stock buyback that these corporations are doing. Well, for one, they're borrowing money from the pension funds, and then they're buying their own stock. What do you think would happen with the stock market? Doesn't that make sense that it would rise as high as it has? Then what happens when the pension funds no longer need those bonds? Not only not need them, don't want them. And it's not a matter of need. They need the bonds. They want the interest rate off of the yield off of it, but they're not getting it, so they don't need those things anymore, and they want to unload them. That is going to put the corporations in a bad position, and they're going to have to start selling their stocks, which is going to cause the stock market to go down too. I don't know how many people kind of put this into their thoughts about what's going to go into the future. But if we have an inflation scenario that continues to rise, then it's going to put even more pressure on the real returns, on the real interest rates. So as inflation expectation rises, real interest rates are starting to fall. These pension funds are put in an ever more difficult position in which that they're probably going to start selling. What would happen after that? Uneducated Economist. You guys let me know.